Uh, Good morning, everyone, and welcome to good evening, everyone, and welcome to today's session conducted by the BISP Solutions. At BISP, our aim is to simplify complex financial and tax topics so that even beginners can understand them and use them in the real world application. Today, we are going to talk about a very important topic in the Oracle TRCS, that is setting up of tax rates. Now, let's ask us that why this topic is important, because without the correct tax rate, tax rate, TRCS cannot calculate the current year tax expense or deferred tax balance properly. You can say that, think it of as like baking a cake. Here the TRCS is the oven, but the tax rate are the recipe instructions. If the recipe is wrong, then the final cake will not taste right. You can even say as there are two valuation, that is that is the raw that we are feeding. We can take any number, that 1 plus 1. Here we don't take the plus right now, but it should answer us to 2. If we actually use the minus, it will give us the 0, so we will put plus so that we get our answer 2, which we are supposed to get it right. So let's start that we are gonna discuss it, and by the end of this session you will be able to understand the national and regional tax rates, what tax rates are, learn the difference between the prior year, current year, opening and closing rates, understand that what the regional tax appointment means, and even how to apply the override tax rate when exceptions are required. Right, so let's get started step by steps in simple words and practical examples. So first of all, if we want to navigate to our tax rate, that means we have to actually set up tax rate. So before going into that, first we will duplicate our application, because we will be needing a duplicate application right here. This is the same application, just I have duplicated the tab so I can see two things at the same time, right? So from here I will first go to our tax provision national, and we will duplicate it once more, tax provision national package. Under this we are going to go to the application to configure our tax rates. Under the configurations, here we can see that we have an option, that is our tax rate, right? Let it open, and we will go to the tax provisions, and we will open here, and we will go to our regional tax provision. Okay, let it actually open it up. Alright, so we don't have the data in here. I think FY 2022 does have. Alright, so we do have. Okay, now, so first of all, we will start with the what is the basics of the tax rates. So TRCS is used by companies to automate the tax provision calculation, but to perform this calculation the system needs to know that what the rate has to be applied on the taxable income, right? These rates are not just numbers, but they are the statutory tax rate as per the law of a country or region. For example, Indian may provide a GST of 80%, but that is the tax law. But according to the American or the Chinese law, it can be 20%. So this helps us in applying the tax rate through this dashboard right here, that what is the tax rate that we need, even under the national one or under the regional one. Here we will study about how the national and regional differently works. Now, for making it easy for you to understand, if we can take an example and understand it. For example, if your taxable income is 1 lakh and the tax rate is 25%, then your tax expense will be 25,000. Now, imagine if a system has a wrong tax rate. If the tax rate is stored at 30% rather than the 25%, then the tax rate will become 30,000. So there's a huge error of 5,000. And as actually the tax regulatories are very particular about the laws and the regulation itself, so they have to actually follow them up. So this error can make a huge mistakes in your sheets, and you can even be imposed penalties or some sorts of other punishments, right? So so entering the here the entering the correct rates ensure that the accuracy of tax expense reporting, that means it is accurate to this so we can forecast or plan to the that what will be our next actually tax expense. Then it corrects the deferred tax balance, that what is the adjustment that we have made, it is actually according to it or without it. And we can say that the reliable ETR reporting. Think of tax rate as the fuel that runs the TRCS engine, right? Now, before going in depth, here under this we have actually two types. The first one is the regional tax, then we have the regional tax rate. So I will make you understand. As under this we have two different cards. One is the tax on, let it load. Here we have, one is the tax provision regional, which means that the regions under a national geography, and tax provision national, that means it's taking national as a whole. We are talking about India, China, USA, United Kingdoms, etc., right? So under here you can see we have the national, that is the United States. We have the regional, that is Alabama, Alaska, California, Connecticut, Illinois, Nevada, Ohio. And then we have a US blended. So here blendeds are the other regions which are not recognized by the system, or you can say it is the others department that we have to put other region inside it, right? So here the national tax rate is the main federal or the government tax rate. For example, in US the federal corporate tax is 21%, right? And in regional tax rate, these are the tax that are provided by the state or provincial rate, provincial areas, right? So example, Alabama may have a 6.5, California may have a 8.8, right? Each state adds its own rate to the national tax. For you can say that, for example, if the national tax rate for America was 10%, then the Alabama might have 5%, and California may add 3%, and 2% will be the blended one. That makes the whole tax to 21%, right? So we will come to our next one, that is our US blended. Under this we are gonna go that US blended is a specific region that is not listed, right? The TRCS assign it to be a blended rate, as it refers to that the other departments are under it. We can take a scenario, that is, for example, if a company that operates in 3 different states in the USA itself, then what will it mean? That the national on the national level the US is 21%, California is 8.8, Texas is 0%, that is no corporate tax, or in Ohio is 6%. That means the TRCS will take each state portion of income and apply the correct combination of federal plus state. Without entering these correctly, you cannot generate the accurate provisions, as it will cause mistake, and I have already told you that you can be actually imposed a hefty penalty on yourself or a punishment, right? So without delaying, let's move to our next one, that is regarding the prior year current tax that I have actually told you in the starting. Current year, then opening deferred tax, closing deferred tax. So first start with the what is the prior year current tax rate here. So the statutory rate that applies last year, or the stored for comparison and reporting, which refers to a prior current tax rate. It is used in the prior year column of reports. For example, if 2022 had a 21% federal rate, that goes here. Current year current tax rate refers to the statutory rate for this current year that is ongoing. It is the most important field, as it's used to calculate the current year tax expense in provision, means tax provision, and the ETR itself. Then the current year changes in deferred tax roll off. So for we can take example to ease it off, that is if 2023 has 25% federal rate, that goes here. Here you can see that the prior rate is 21, and if we need here we can actually put the 25% right here. Alright, next we have our opening deferred tax rate, that is non-current. So here the tax rate at the beginning of year for deferred tax balance, it ensures the starting balance of deferred tax is correct or not. We can take example that the temporary difference was 10,000, the opening rate was 25,000, so the opening deferred liability will be 2100. Right, these are actually applied on the deferred tax that we are gonna see, or I can just show you under that where it is. Here you can see we have our temporary differences and the permanent differences. And these we have many different deferred taxes right here. Actually I'm unable to scroll now. Sometimes it may create some sorts of error there where you are unable to clear because you have actually opened so much of the columns itself or the accounts itself. Now we have our next one, that is the closing deferred tax rate non-current. So it refers to the rate used at the end of the year for deferred balance. The opening deferred tax rate for non-current is the opening balance, the closing one is for closing balance. Ensure that the closing balance matches every statutory requirement, as you have to report it for the current. That means the closing one is for current. Right, so for example the same difference we will take, that is 10,000, the closing rate is 25,000, so the closing deferred tax liability will be 2500. Right, so let's talk about that why both opening and closing. Because if the rate changes during the year, the TRCS can track the impact of rate change on deferred balances. Here we are talking about the percentage that we are manually gonna enter it under the different opening and closing. Right, so under this we have the next one, that is our opening regional tax. That we refers to that the prior year allocation that is used for opening balances. Right, then we have current year, that is current year allocations. And as you know that what is the closing means that the end year of allocation. All right, so the opening refers here that it is used for basically opening balances, current year is used in the provision itself, and the closing is used for deferred balance. Companies don't earn all income in one state, must be there must be another split source, or you can say the income must be split across different states. Right, apportioned, you can say it apportioned. Right, so the TRCS allow you to define this percentage. We can take example that the total taxable income is 1 lakh. California share was 40,000, that is 40%. Ohio shares was 60,000, that is 60%. If a CA rate, I'm taking CA, that is the prefix of California, that are the two digit code that we actually denote it. Right, so that means if the CA rate, that means the California rate was 8.8, then the tax will be 3,520. Or according to the Ohio, we actually denote it OH, that means the Ohio rate, if we put it on 6%, the tax will be 3,600 on 60,000. Right, so this is how it actually works. Let's actually let me show you that how it works on Excel, so it will be it will help you out in understanding. Under this we are going to go on our Excel sheet. Here the total tax is 1 lakh, right? So if the total tax here is 1 lakh, and the California, we will first of all write the California and OH, that is our Ohio. We will write the full name. And here it will be Ohio. For example, we have 40% of this value and 60% of this value, the Ohio rate. These are our rates, right? We'll just bold it so you will get the easy way. All right, under this, now if we actually talk about that, these are the share percentage that we are actually talking about under this. So the share percentage according to it, here it will be 40,000, here it will be 60,000. Now under this, if we put the tax rate, if the tax rate was 8.8% that we have actually taken for California, here we go, that what will be the tax right here. So here we will take, this is 3,520. We can even take it in rupees or dollar, whatever you like, and for this we have taken actually 6%, that we will take it as right here. So the total tax here will be of 7,120, right? So this is how actually the different region apportionment actually means, right? Under this, the next block we have here is the active region flag, right? So it just means that it's a simple yes or no switch. If it's set to active, that TRCS calculate tax for that region. If not, or no, then TRCS ignore that region. For example, I have ignored the region like Illinois, Minnesota, and Nevada, Ohio, different thing. I can actually switch it from here. This is a drop down. We'll click on it, arrow once, search as it is active. You can actually say it's only active. We don't have any other option right here. Okay, no, it's we don't actually have to do it. But if in this, as it's a demo instance, so we may not have here. But in the actually when you create an application, you are not doing the training there, you have actually data, so you can get you will actually get, not can, you will actually get here that to deactivate or activate it. Yes, we don't have the data right here. All right, so this is no problem. So for we are gonna again take a if example, if California is marked active, TRCS will not calculate TRCS will calculate for California. If it's not marked active, that means TRCS will not calculate California tax even if income tax exists there, right? So here the point of view we are saying here, the POV, we also have the POV, that means we have the dimensions right here that we've already talked. We have actually defines which scenario you want, what is the year you want, and the entity you are applying rates to. Example, I have taken the scenario actual, the year is 2022, the entity is operation US under the North American region, that is LE101. Always check the POV before entering the rates, otherwise you may apply it to the wrong year or entity. For example, if I change it to a different entity from here, entity, I'm getting only one entity. Alright, it's not a problem. So you have to actually define it according to their need, as all the pages will set according to it, right? So now under this we have the next one, that is a deferred tax override rate. So sometimes the statutory rates are not good enough, meaning certain temporary differences may be taxed at a special rate, where which the TRCS allow you to override the rates for specific accounts. Here you can see that for tax rate I have 20% applied for the fixed asset book depreciation, that is the current year as well as the closing rate, right? So how the override works is, if no override, then the TRCS use the current year rate, and if there is a override entered, the TRCS applies the override only to the account, right? For example, we have a current rate of 30%, but if we override it to 40%, the temporary difference that we have of 10,000 will change according to it. If we have a current rate of 30% and temporary difference is 10,000, then it means 3,000 is a deferred tax. If we override it to 40%, that means the 4,000 is a deferred tax. The TRCS automatically books the extra 1,000 as the adjustment. When overrides are needed, tax laws carry forward tax at reduced rate. Specific accounts where laws prescribe specific special treatments, and even the regional rules that differed from the national law. Overrides can be even national and regional itself for federal and state provisions account. Right. Next, we will go and see that how it actually works. This is here for the national one, and this is here for the regional one. As you can see that under region we have the US region and different regions, but if you go under the deferred tax override rate, under this you won't get any. You don't have the drill down button, so how are you gonna do it? So let's take an example, not in the deferred ones. We are going to start with the tax rate ones. Here we have the current provision for the national, and here we have for the regional. Then here under the US domicile, we are gonna go with national. We are having the 21% right here. We'll change it to 25% right here. Before that, we will just look up that how much it's charging. Here it's 21%, and here it is 66,68,000. Let's change our current year tax rate here. We'll go save it, as we have get the notification that the data has been saved. Then we'll go to our current provision, and here you will refresh the data. Here you can see that the 25% has been changed, or 21 has been changed to 25%. But if you click on it, you can see that the difference here is in points because the data is very wide, right? So here you have seen this one. Now we will do it for regional one. Here we will, instead of 6.5, we can go for 9%, or we can go for 5%. Instead of 6.5, we are going to go for 5%. First we will see that what is the actually under what we are actually going. We are doing for Alabama. Under Alabama we have the rate of 6.5, that is 33.99. Let's save it. We have we have 2,20,000. Then we will actually refresh this form. Here you can see the 5% has been adjusted, and according to it all the current year tax rate and different tax will be adjusted, right? So it's a very easy form that let you actually change the rate itself of the different actually taxes according to the region or the national. And even we can say that the deferred tax we can even override it for some of the different things under this sheet. As you can see, we have different accounts. For example, we can have non-deductible insurance, or we can have it for fixed asset book depreciation, or we can have it for the fixed asset tax depreciation. Whatever you would like to do it for according to the client's need. So till here